It's so much fun and easy to buy stocks, but how hard and difficult is it to know when to sell? So I think if we focus, Brian, on the 4 reasons that I sell stocks, maybe that can be somewhat of a takeaway as we focus on the news this morning. But I'll start with number one that might be unique to our strategy. The first thing that we do is we sell covered calls. We sell out of the money covered calls. So sometimes we'll get a stock called away, and that's great because, again, you're selling something higher. We're contractually obligated to do so. The second rule, which I think everyone should use, is rebalancing, good old-fashioned rebalancing. We allocate only 5% to any one name because, as we're seeing here with some of these Chinese gaming stocks, you never know what can happen.
Yeah.
So we want to risk budget, spread our risk 5% with any one stock, no matter what our conviction. If they grow to a 7 or 8% weighting, we use old-fashioned rebalancing. We trim it back. That's how professional investors get dry
Kevin,
power.
before we go to 3 and 4, because I think these are very important lessons. We always talk about buy, right? When to buy. Well, when to sell is incredibly important too. I want to go back to that covered call because it is early, might have some new viewers, new investors. Explain to us quickly, and of course in TV way, what a covered call obligation might be. What does that mean?
As quickly as I could use the analogy, we're selling someone the right to buy a stock from us at a predetermined price, much like a lease option in real estate. So some people will put in a sell order. If a stock gets to X price, we'll sell it. In a covered call, you're doing something very similar. You're agreeing to sell something you own for a price higher than it is today, but we're compensated for it. Very similar, again, with that lease option in real estate. It's like a rental contract with a lease option to buy. How was that for a brief analogy?
Listen, I thought it was very good because, again, you don't necessarily always have to sell a stock. You can write that covered call against it, but then the call gets, well, called, and then you have to sell. All right, let's go back to 3 and 4, sort of on that discipline of knowing when to sell. And of course, this all comes back to what you and I have talked about, Kevin, which is a relationship. You buy a stock, you make money in it, you kind of love it, right? It's like a relationship between you and the company. But to be a disciplined investor, you got to take the emotion out of it.
You can't be more right because it's so difficult. You've made this investment, you've researched it, you want it to go up, you never want to be wrong, you never want it to go down. But the reality is, as professional traders, stocks do go down. And when they do, you need to be prepared to keep those losses to a minimum. So for me, if a stock cuts or suspends a dividend, more times than not, I look at that as a weakness in the underlying company or the environment, and I just remove the stock immediately, regardless of that emotion. And the fourth reason, which everyone I think could also benefit from, is looking at relative performance, very specific to the stocks. If we own a name and it's underperforming its peer group or its sector by 15 to 20%, then we have to acknowledge that the economics of the company may have changed somehow, or it wouldn't be outperforming or underperforming its peer group. So we remove it from the portfolio. We can figure out what's wrong later. But the challenge for investors is, boy, do I sell now? Will it go back up? What happens? What if? You've got to remove the what ifs. And like you said, Brian, you've really got to remove the emotions. It was Benjamin Graham who said that the best portfolio managers are those that can manage risk and navigate the downside. And if you can do that successfully, the upside will always take care of itself.